morning for everyone that's joining us. We're just going to give it a minute or two for everyone that's registered to join, and then we'll get going with this morning's webinar. So just give it another few minutes for everyone to dial in. Welcome to those that are just joining. I hope you're all well today. Brilliant. Okay, yeah, so a few more people just joining, then we'll get started. Today we've got Justin Oliver from Canaccord, who's going to be presenting today. And I'm sure many of you have heard Justin before. I certainly have a few times, and I was looking forward to this one because Justin's presentations are always really interesting, and the topic itself is extremely interesting. So what Justin's going to cover today, his title is "Has the Worm Turned?" And that's referring to, as we all know them, the Magnificent Seven. So your Alphabet, your Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. And looking at how their performance has changed. So in 2023, sort of aggregated, their performance was 93% over and above, and then nearly 32% at the end of June. However, interestingly, since mid-July, that seems to have started reversing. So Justin has sort of taken a look at this, and he wants to explore within this presentation today a bit more about why this is reversed and examining the prospects for these Magnificent Seven going forward. So I think you'll agree it's a really interesting and really topical conversation to have today. As usual, we have a Q&A button that's at the bottom. So we would absolutely love your questions to come through as and when Justin is presenting, and then I'll feed them back to Justin at the end of the presentation. So the presentation is going to run to about 30 odd minutes, and we've got about 10 minutes for Q&A at the end. Today we've also got available a certificate at the end. We got there in the end. So if you want a certificate, we actually do have one, so I can send that to you. If you want to contact either Steve or I, and then you've got that for your records as well. I have to apologise, female in my mid-40s, words disappear sometimes. So thanks everyone, looking forward to today. Justin will be a far better speaker than I am, I can assure you. So I'm going to hand over to the expert. Thank you very much.
Thanks very much, Linda. My mind had a blank on the word certificate as well. So you're not alone. It's also 50-year-old males that occasionally use their words as well. Yeah, certainly thanks for the introduction, and thanks for the opportunity to speak today. Obviously, yeah, the title of the presentation is "Has the Worm Turned?" And for those of you who aren't familiar with it, it's a bit of a British saying. I think in its narrowest context, it means pretty much are the downtrodden about to rise up. And actually, in this way, we can talk about downtrodden either being actually those Magnificent Seven, as you rightly highlighted, Linda. They've underperformed. Are they going to sort of turn around and outperform once again? Or actually, we could talk about the other part of the market, those areas which have underperformed over the past couple of years more generally. Are we going to see areas outside of technology once again come to the fore? And we really want to explore a few of those areas. So again, if we just take a look at the background, what we've done here is just taken a look at the performance of asset markets for 2024, the year to date, going up to sort of the 27th of September in US dollar terms. I think the good news is, clearly it's been a good year. Most of the bars are pointing upwards, so markets are making money, which I think makes all of our lives a lot easier. Obviously, blue bars are actually markets, grey are bonds, and orange are commodities, in case gold and oil. And most things are up. Only oils are off a little bit, and Latin America. Everything else has made varying degrees of positive returns this year. But again, as far as the conversation we're going to have today, what's notable is that actually those Magnificent Seven stocks, and we'll go through which companies they are exactly in a short while, they have made again tremendous returns so far this year. Hasn't all been plain sailing, but on the whole, where you've wanted to be invested is in those technology companies. And obviously, that's fed through to sort of global technology equities and actually US large cap stocks more generally. And you see actually also gold has performed well. We'll go into during the Q&A, we can go into reasons why gold's performed so well for a variety of reasons. But actually, again, a very supportive year. And actually, that really shouldn't be a surprise to us because what we do know from economic and investment history is that actually markets typically do quite well when the Federal Reserve are doing nothing, when they're sort of keeping interest rates on hold. And that's what we're kind of we're showing here. We're looking at the returns, in this case, of the US stock market, the S&P 500, during periods when the Federal Reserve have been keeping interest rates steady. Clearly, that's been the case for most of the past couple of years. Obviously, there has been a bit of a change over the past couple of weeks, which we'll come into. And again, that might be a few slides there, which might make us all a little bit uneasy. But it was basically the second longest period where the Federal Reserve have kept rates where they are. And actually, it's been the best period where rates have been held in terms of the S&P 500's performance. So great news. There are now going to come a few slides which you probably won't like because it makes it distinctly uneasy reading. Again, I'll say it's not necessarily our base case, but I think in terms of portfolio strategy, you've got to be aware that these what might occur is not necessarily going to be that good for equity markets, and at least argues for why you want to have diversification away from the US and away from large cap technology stocks. And that's because whilst the market environment is typically quite good when the Federal Reserve is doing nothing, it does tend to become a lot less supportive when the Federal Reserve starts cutting interest rates. And as we saw a couple of weeks ago, the Fed has embarked on a new monetary easing cycle. They cut interest rates by 50 basis points. And if we go back all the way back to the 1970s, we're about 8 periods there when the Federal Reserve had been easing or been cutting interest rates. Typically, over the next 200 trading days from the first Fed cut to the S&P market low, the market loses about, on average, 23%, or it certainly has done. The only time it hasn't actually lost money was in the early 1980s. But in every other period, when the Fed has begun cutting interest rates, the market has fallen, and often quite significantly. Then we need to ask, well, why is that? Surely, cutting interest rates is a good thing. Well, actually, yes, it's a good thing, but bear in mind, why is the Federal Reserve typically cutting interest rates? Well, they're typically cutting interest rates because they're concerned that economic growth has been slowing, and they're trying to prevent a recession. And the problem is they're not very good at preempting recessions. And actually, recessions are very often followed at the first interest rate cut. Again, that's what we're kind of showing here. So the Fed first began cutting interest rates in November 1989. We saw a recession begin in August 1990. They cut at the end of 2000. 4 months later, in April 2001, a recession followed. Same sort of thing in 2007, 2008. And I think we can make a very negative case because, again, the Federal Reserve is trying to preempt at this moment in time a slowdown or a potential slowdown in terms of the US economy. If you were a betting person, you would suggest that history kind of indicates that they've left it too late to begin cutting. And again, I can make some, I think, relatively convincing cases for why this time might be no different and a recession might ensue. Not least is the fact that we've already started to see unemployment beginning, to increase. And even if we think interest rates being around 5% at the moment, what's the kind of neutral level of interest rates? So, where are interest rates where they're neither stimulating nor restraining the economy? Again, it's very difficult to know in advance. Most people, the best guess would typically be around, let's say, 3%. So, we've got to get down to 3% before interest rates are not having a negative impact on the economy. But even now, the market's saying, well, those 2% of interest rate cuts to come aren't going to happen for at least for the next year. So for the next year, interest rates are going to be relatively restrictive, probably becoming less restrictive, but they'll act as a restraint on the economy. And if we're already seeing the economy start to slow down, that might not be good news. Now, the really worrying thing, comes next. So if we're saying, well, let's say if a recession, does happen, and again, I think the jury's still out in terms of whether that does happen. There's reasons to say, well, it might be different, this time. But let's say a recession does happen. Why is it so important that we get to grips with whether there's going to be that economic slowdown? Well, because what happens in an economic slowdown is actually, funny enough, corporate profits, tend to fall. Again, it's not as surprising. We've got a recession, people have got less money to spend, and basically people spending less money impacts corporate profits. And if one company is making less profits, they've got less to invest, and there's kind of that vicious circle ensues. Because bear in mind, one company's spending might be another company's income. And again, we can see that going all the way back to the sort of the 1980s during recessions. Operating earnings or corporate profits of the S&P 500 decline, and it's been from anything from a relatively mild 5 or 13% all the way down to sort of 50% during the global financial crisis of 2008 2009. But let's say we have a relatively or try to put together a relatively modest forecast for an earnings decline. Let's say earnings go down by a reasonable 10%, which is, I think, being relatively conservative. And let's also say that actually the price earnings multiple of the market, so again, how richly US equities are valued, moves back to its sort of average level. So in very broad terms, at the moment, the PE of the US stock market is around, let's say, 22, 23 times. Prior to sort of the global financial crisis, and even outside of recessionary periods, the average PE of the US stock market is around 15, 16 times. So what does that mean? If we put the stock market in a PE of 15 or 16 times, and then say all corporate earnings fall 10%, which would actually be a relatively mild slowdown, what does that imply for where the S&P 500 is trading? And this would be basically the really bad news. So actually, when I was looking at the stock market at the S&P 500 this morning, it was trading actually around 5,700. But if you put in a PE ratio of around 16 times, corporate earnings falling by about 10%, that implies that the S&P 500 would be trading at around 3,800. For those of you who are very quickly going to your calculators and figuring out what does that imply for actually a market fall, I very helpfully put it up there. It's about 32.5% decline for the S&P 500. So that is why it is so important, and that's actually why everyone is focusing so much on the US economic situation, what's going on with employment, fixture, to try to get a situation of is the US about to enter recession, because that is clearly a very important forecast to get right. And really, I think at this moment in time, the US market is kind of priced for perfection. It's priced for there just being a relatively modest slowdown, which probably doesn't have any impact in terms of corporate profits or any impact in terms of the price earnings ratio of the market. I think when we're looking at our central base case scenario, we do think the Federal Reserve, by cutting interest rates very quickly, as they have done, that first 50 basis points cut is the right move to make. But again, that shows why, I think why it's important to get that right. And again, going back to, that's why it's important to get your, perhaps your diversification. That's why it's important that you hold markets other than just the US. So that was really sort of the bad news. Again, this presentation isn't going to be all bad news. There are going to be some, we think, some positive areas perhaps to focus on. But again, as Linda highlighted, what we're also going to have a look at is not just the US, but we want to have a look at the largest component of the US stock market. And actually part of the reason it's done so well over the past few years is because of its very big weighting to the darlings of the investment world at the moment, which is basically the technology arena. And the US is the standalone market in terms of having such a large weighting to those technology companies. Other areas have a much more modest weighting, in particular the UK, and Europe. But again, that's also, part of the problem. That's part of the considerations we need to, understand when putting together a portfolio, is the fact that these 7 companies, these magnificent 7, as they become known, comprise such a very large part of the S&P 500. Over 30% of the stock market is made up by Microsoft, Apple, Nvidia, Amazon, Alphabet, Meta, and Tesla. The other 493 companies make up the remaining 70%. So actually, from a risk perspective, is the US stock market, diversified? Well, actually, no, arguably it's not particularly, well diversified. In fact, if you look at, back at our investment history, because you might say, well, yeah, this has always been the case. Markets always tend to be dominated by a few, large players. You're absolutely right. But the fact is that though that concentration has increased significantly, over the past few years, to the extent that we're currently at unprecedented levels. So this is, again, just looking at the top 10 largest stocks as their percentage within the S&P 500. And currently we're at pretty much record highs. It's about 35, 36%. If we go back all the way back to the sort of the end of the 1990s, and for those of you who have been involved in the investment world for as long as I have, you'll probably remember the technology bubble and bursting at the end of the 1990s, beginning of 2000s. And again, yes, at that stage, the market was dominated by very few large players, but even then it reached a peak of around 27%. So we can say actually the concentration of the market is even more extreme than it was, during that period. So again, take a little bit of care about how much exposure you've got to these, these particular companies. And I think, again, we're very good in this investment world about saying, actually, what you should do is diversify your investments. It helps, reduce risks. But actually, we should also be conscious of the fact that actually, diversification hasn't really helped portfolio managers much over the past, few years. In fact, if you're just looking at the US stock market, there's only been one sector that's outperformed over the past 5 years, and that's actually technology. All of the other subsectors within the market have underperformed. And actually, even that, some of those sectors include those technology companies, those magnificent 7. So communications, which have been the next best performer, still underperforming over the past 5 years, but communications includes Meta and Google. Discretionary companies, which is Amazon, includes discretionary sector includes Amazon. So actually that includes some of those technology companies. So really, diversification hasn't particularly helped over the past few years. Will it help more going forward? Well, I think if you're a betting person, you would suggest the balance of probability would suggest that this sort of picture that we've got here isn't likely to persist to such an extreme over the next 5 or 10 years. As Linda mentioned, for most of this year, we have seen those magnificent 7 outperform. So going through to from January to July, again outperforms in this case the S&P 500 by about 27%. We then saw a little bit of weakness over the summer months, and that's again partly what we'll come on to in the next slide. I think that's slightly due to some disappointment in terms of the earnings of some of these companies, particularly in relation to AI. Again, AI has been one of the greatest buzzwords, one of the greatest themes that we're seeing within the market at the moment. There's a lot of hype, a lot of excitement about what AI might and can do in terms of companies. And again, that's driven particularly stocks like Nvidia, which again basically just makes the chips which allows AI to work. But most notably, if we look back at Nvidia's recent results, again they were blowout results, really, really strong. But actually the shares fell after the results because they weren't quite as strong as some of the most optimistic analyst forecasts. And actually they did show a bit of a deterioration in terms of the pace of growth. Previously, earnings growth for Nvidia had been something like, let's say, 250, 260%, sort of year on year. That kind of declined to 200%. And for some reason, the market's got slightly disappointed with that. But I think that's part and parcel of where we are in the investment environment right now. There is no company in the world that can continue to grow its profits by 200% plus quarter after quarter after quarter indefinitely. After a while, the maths just doesn't add up, and that's what we're going to see with Nvidia. Yes, it will continue to grow. Yeah, of course it will, but it would be foolish to assume that that pace of growth will continue at the same sort of levels as it has done in the past. For a variety of reasons, the mathematical impossibility of it being for one, and actually let's also bear in mind that Nvidia has had a pretty much of a monopoly on the production of these chips in the past. Whilst that monopoly might persist for a while yet, again, the capitalist world that we live in suggests that that competitive advantage is not going to persist indefinitely. Other companies will be investing heavily to try to catch up with Nvidia, and therefore Nvidia's competitive advantage you would expect to diminish moving forward. But whether that's in a year's time, whether it's in 3 or 5 years' time, who knows? But again, we're looking at investment and economic history. But again, part of the reason that's again, this is bringing that corporate profits growth and the reasons for the Magnificent Seven's outperformance into some sort of context. We're looking here at the performance or the earnings growth of the Magnificent Seven compared to the rest of the market. If we're looking back at the fourth quarter of 2023, clearly part of the reason that they've performed so strongly is because, rightly so, they were earning, and their earnings growth was a lot higher than the rest of the market. And it will remain that case, but we're starting to see that gap diminish as we're going into the future. So the earnings growth, they'll continue to deliver higher earnings growth than the rest of the market, according to analysts' forecasts, but that premium won't be as so high as it has been in the past. And again, if you're kind of going back to basic logic, it would kind of argue that maybe we've seen the best of the outperformance from those Magnificent Seven stocks. They might continue to outperform moving forward, but that margin of outperformance might be less than we've been used to. And also, I think the market will be more discerning in terms of the individual stocks. Certainly, companies like Tesla have not been growing their earnings. In fact, they were under a lot of corporate pressure from Chinese EV manufacturers, BYD, etc. And certainly some of the valuations there are a little bit rich. And again, we can make various points about maybe some of these Magnificent Seven companies have gone X growth, so Meta, for example, and that's why they're now starting to pay dividends and introduce share buybacks, because they don't know what else to do with the cash flow that they're generating, or that they're just so big that any acquisitions they make really won't make much of a difference to their bottom line. And I think, again, what I sort of touched on valuations there, and I won't go through the valuations of each of those 7 stocks, but again, I think one of the key messages always in terms of the investment world is to be very careful about the price you're being asked to pay for certain companies, because price is the most important determinant of future returns. So what we've done here is taken a look at the price to sales ratio of Nvidia, and we compared that to what was one of the stock market darlings at the end of the 1990s, which was Cisco Systems. Now, Cisco and Nvidia, I think, have some general similarities in that they provided the hardware, which makes, in the case of Cisco, it makes the internet work. In the case of Nvidia, which makes AI, basically work. Now, Cisco's price to sale, reached over 60 times at its peak, which clearly was a ludicrous level. But actually, Nvidia's, which has peaked at 27 times, do not be under any illusion that that is cheap. 27 times sales is still extremely expensive. And I think if you time your entry point wrongly, then it can take you a very long time to get your money back. And that's what we're kind of showing here. In this case, we looked at Cisco Systems and 2 of the other Magnificent Seven, which were around at the end of the 1990s in terms of Amazon and Microsoft. And we said, well, actually, if you bought those shares at their peak, how long would it have taken you to get your money back? So we rebased everything to 100. The grey line's Amazon, and that shows actually if you bought it at its peak at the end of December 1999, it would have taken you 10 years to get back your money. And in the meantime, you had to undergo a share price decline of around 90%. Now, clearly, since that time, it's been a fantastic investment. You've enjoyed multiple returns on your money. But back in the beginning of the millennium, it was obviously a much smaller company, and actually its future at one stage was seen as very uncertain. And as I say, the share price fell by 90%. So you have to be a very patient and a very brave investor to sort of ride through that storm. Similar sort of thing in terms of Microsoft, which is the sort of the orange line. There, if you bought them at their peak, the end of 1999, again, it took you about 13 years to get back your money. But really, I think the interesting one there is Cisco Systems, where if you bought them in their peak was about March 2000. And the fact is, if you're still holding them now, you have not made your money back. Yeah, for all of that period, apart from two very brief windows last year and the year before, you're basically still underwater. You haven't made your money back, and this despite the fact that all the dividends which have been paid, in the interim. So again, the price that you pay for something is extremely important, and be aware of some of the valuations that are inherent within these large cap technology companies. And I think also that there's an assumption that the Apples, the Amazons, the Metas of this world, they're always going to be around. They're always going to be the largest companies in the world. So why wouldn't you invest in them? Well, actually, I think one of the other things that we've looked at and we've learned is that actually the largest companies in the world do change over the decades. And actually, so whilst it might be almost unfathomable at the moment that, of course, Amazon's always going to be there. Of course, we're going to have Apple, etc. Well, actually, if you're a betting person, you would say, well, maybe in the 2030s, there'll be another top 10 largest. And maybe most of these companies which are there now won't be there. Because if we look back at 2010, of the current top 10, which were still the top 10 in 2010, well, basically you had Apple and Microsoft. If you go back to 2000s, it's only really Microsoft. So again, the top 10 does refresh itself. And again, just thinking in terms of the AI, this is some of the work that we're doing. Actually, maybe some of the future winners will be AI related stocks, but maybe it won't be some of the companies that we've got at the moment. If you think about Alphabet, Google. We almost use it's our go-to, or for most people, it's the go-to search engine. But I know with Google that I'll type in a question, I get presented with lots of websites. I have to find out the answer myself. Well, actually, compare that to AI or ChatGPT, where you type in a question and you get presented with an answer. Well, actually, I can see increasing uses and increasing reasons why people might go to AI rather than Google moving forward. Now, maybe it's a case that Alphabet will have the AI search engine that we'll all use in the future. But maybe it won't. Maybe it'll be something that ChatGPT. In which case, what does that do for Alphabet's business model, where most of their revenue still comes from advertising linked to the search engine? And similarly, again, just to sort of wrap it up in terms of valuations. Again, going back to what I said, the US stock market is not cheap. As things stand, trading at 22, 23 times. That's not quite as expensive as it was at the end of the 1990s, but it's certainly well above the average ratio of 15 or 16 times. And actually, if you're conscious of the price that you're paying for something, actually other markets give you better value. Maybe not cheap, but certainly not as expensive as the US, which is trading around 33% higher than its sort of medium level. For us, and again, when you're looking to introduce diversification within portfolios, you're looking at areas like, China. We might touch on China during the Q&A. Very, very cheap, unloved, I think for good reasons. But the fact is the MSCI China index is off something like 60% over the past 3 years. Is a lot of the bad news already in the price? Well, yeah, probably. Does it mean it's going to get better tomorrow? No. But actually, bear in mind, sometimes the news doesn't have to be good for economies and stock markets to make progress. Sometimes it just has to be not quite as bad as feared. And that's where we'll kind of introduce now, just to wrap up. Just have a look at a couple of other areas when you're putting together your portfolios. Japan has very much made the investment news over the past year or so. Early on in the year in particular, because at long last, the Japanese stock market finally surpassed its 1989 peak. And again, another reason for being careful about the price you're paying for something, because clearly at the end of the 1980s, Japan was trading on ludicrous, valuations, because no one thought the party could ever stop. 30 years later, you've only just got back to that sort of level. Clearly, the stock market was in a bubble then, but sometimes bubbles are only really easy to appreciate with the benefits of hindsight. We've seen the stock market give back a little bit of ground more recently. So again, it's trading below its all-time high once again. But in valuation levels, it's much better valued than it was at the end of the 1980s, not least because you had 30 years of corporate profits growth. Actually, lots of reasons that we like Japan at the moment. Its economic performance has been much, much better. It's finally moved away from the deflationary quagmire that it's been stuck in for much of the past 30 years, and perhaps one of the few economies which actually wanted a bit of inflation. I think the key one, however, is corporate governance. For much of my investment career, Japanese company management have only really managed companies for one set of people, and that's themselves. They haven't really given much concern to basically the owners of the company or the shareholders. But for various reasons, a bit of a carrot and a stick approach, that has begun to change. And they've therefore introduced better corporate governance. That's been via ways of reducing some of the cross shareholdings that they've got by introducing more shareholder-friendly reforms, etc., all of which has served to help corporate earnings growth continue. Actually, valuations in the Japanese stock market in a global context are still relatively reasonable. And I think from from an overseas perspective, you've got a decision to make in terms of the Japanese yen, which has been very, very weak, starting to strengthen once again. So you can take a view on whether you want to hedge the currency or not. From our perspective, we would be having an exposure to the Japanese yen, not least because I think the yen's going to be relatively strong over the coming weeks and months. And again, just to give you an idea in terms of the corporate revolution that's been going on in Japan, we're just looking at the dividends and the share buybacks that have been introduced. You can see that positive momentum behind the market and that positive tailwind. The other area just to look at before we wrap up is the UK. Just a couple of things to say as far as the UK is concerned. Firstly, it is very cheap. Once again, so we're going back to 2006. At that stage, the FTSE 100, so the 100 largest companies in the UK, and the S&P 500 were trading at roughly the same valuation level. So let's say 15. If the US was trading at 15, 16 times earnings, so was the UK. Fast forward to 2024, and actually the UK is now trading at half the level of the US, so about 12 times compared to 21, 22 times for the S&P 500. So it's very, very cheap. Now, partly it is cheap for reasons. Economically, there are many reasons to be worried about the UK. Brexit, from a pure economic perspective, was a case of shooting itself in the foot. The UK has got very many problems to overcome, but arguably that's more than reflected in terms of share prices. But also bear in mind, the FTSE 100 is an international index. 80% of the FTSE 100's revenues come from outside of the UK. So actually what matters more is what's going on in Europe and what's going on in the US for the FTSE 100. And even if you don't like it from an investment perspective, well, actually, maybe other companies do. And that's why we've seen an increase in terms of the inward merger and acquisition activity coming into the UK market. In very broad terms, if you're a box manufacturer in the US and you've got a competitor box manufacturer in the UK, you'll be looking at it and saying, well, actually, that company is trading at a very cheap level. We can, probably buy them. We can then, incorporate their activities into ours. We can strip out some of the costs, and in the meantime, we've ridden ourselves of one of our box manufacturers, in the world. So why wouldn't you? Particularly when our shares are trading at relatively lofty valuations, and you can issue shares, and raise, a relatively large amount of money. So again, that's why we have, I think, started to see that increase in merger and acquisition activity coming into the UK, because a lot of their international competitors are saying, well, actually, the UK is looking relatively cheap. It's time to capitalise on that. So just to wrap it up before we go to sort of Q&A, a few summary and key message points. First, we are going to see further interest rate cuts. In the US, we have begun that cycle. But actually, bear in mind, I think the more quickly the US cut interest rates, actually, the more concerning it is, because the more fearful the policymakers are in terms of the future growth prospects of the economy. At this moment in time, certainly markets are, I think, relatively downplaying the potential of a recession. In the US, that might be right, but bear in mind that with where US stock market valuations are, it's pretty much priced to perfection. It's certainly not priced for a recession moving forwards. So there is kind of downside, moving forward. And certainly, if you're looking at it, markets are expecting double digits of expecting interest rates to be cut by, let's say, 250 basis points over the next couple of years. But it's also expecting companies to deliver 10% earnings growth this year and 15% earnings growth next year. That's a very, very unusual combination, to have, almost unprecedented. And so bear in mind, the US stock market's not cheap, but again, there are opportunities out there. I think it is contingent on the US maybe just going through a relatively softish slowdown. If that does happen, I think maybe the US will be a relatively laggard, but other markets might take up the mantle. And maybe something again we'll touch on during the Q&A session. There's going to be lots of noise, I think, this year. I think the most noisy bit, if you like, is going to be the US presidential election. I think it's too close to call. But again, try to avoid reacting, to that if you can. It's impossible to predict, at this stage. And actually, the choice of president doesn't make as much difference to the performance of the US economy as you would otherwise believe. So with that, I'll wrap up. Thank you very much for your attention this morning. I'm very happy to open it up to any questions you might have. Whether I can answer them or not is a completely different question, but I'll certainly do my best.
Thank you so much, Justin. As always, that was really, really interesting, and tons of stuff in there for us to sort of get our teeth around and consider. I think for me, the slide on the winners change over time was actually quite powerful. You kind of forget, because we're so in the midst of sort of the noise of the Magnificent Seven and US tech bubble and everything else. It's actually quite a good reminder to sort of reflect back on only 10 years ago, that actually looked very different, and that landscape looked really different. And so off the back of that, one of the questions we've had through is, there's a lot of talk about tech and tech innovations, etc. So is there any particular tech innovations that you and the investment team at Canaccord are looking at the moment, sort of outside the Magnificent Seven? Any particular companies or any that you're finding particularly promising that you're keeping an eye on?
I think the general view here, again, we've got people within the firm who do look at individual companies. I'm more on the fund side and the strategy side. But again, the key message I would probably leave you with is that technology, again, it's a very fast moving area. It requires a lot of expertise. And actually, I haven't got the expertise for that. I can barely turn on my computer. But there are people out there who, it's all they do, day in, day out, is look at sort of technology, companies. So I would always look to potentially outsource it. to those specialist technology managers, if you can, because they'll be aware of what's going on. They'll spread the risk across various companies, because look, who's going to win? Who's going to win the AI revolution, if you like? So it could well be Alphabet, or it could well be a company that we've kind of never heard of before. That's one of the messages. If you're looking back now and saying which are the winners, and you compared it to if we were trying to review who would be the winners in 20 years' time, back at the end of the 1990s when we're going through the tech bubble. If you're trying to project and look forward to the 2020s and say, well, who do we think is going to be the winners in 20 years' time? You would not have answered Apple. You wouldn't have answered Alphabet. Because, well, not least because Apple was still a relatively small company and sort of niche computer manufacturer at that stage. Google had relatively recently been floated. We had things like Netscape around, we had some MySpace, etc. So you might have identified some of those. You certainly wouldn't have put the current incumbents there. So again, the future is very difficult to forecast. So key messages: A, spread your risk, and B, rather than trying to throw a dart at a dartboard and highlight 2 or 3 companies which you think might be the winner, maybe look to managers, specialists who just look at technology on a day in, day out basis, because they will probably have a better idea of what are the cutting edge technologies. Again, because sometimes we might all get excited about a certain technology, but it never takes off. So maybe that's also part and parcel of it. So a bit of a cop-out answer there, Linda, because I refuse to give a company. But I say, again, I think the general message is diversify. If you can employ specialists, that's the way I would go.
So there's been a couple of other questions. It's more about sort of country specific. So there's been quite a lot of noise in the press about the China's stimulus efforts the last few weeks, and we've had a couple of queries in as well where people are asking about, there's a lot going on in the Middle East, obviously China, and we've had another query about Spain. Spain has been said to be one of the most strongest economies in Europe, and their housing market, etc. So just sort of your steer on sort of, you mentioned Japan in the presentation, you mentioned the US, China, what's your views on that? At least Spain, have you got any specific views? So it's more of a country kind of specific query, really.
Sure. I think the easiest one to answer, not so to come to conclusions on, but the easiest one to answer is China, because you say some moves over the past week or so, where the Chinese policymakers are trying to introduce more stimulus into the economy, trying to get the stock market up and trying to sort of underwrite the beleaguered property sector, and that does, for me, substantiate something we were saying earlier on in the year. We'll start to take a look at China, because the news there was so universally negative. Again, we reach a stage where the news just can't get any worse, because everyone's kind of sold what they can sell. No one likes it, etc. Actually, that's the time when you want to start getting interested in those areas, is when no one likes it. The time not to buy things is when everyone likes it already, because again, all the good news is kind of baked in the share price. So you could almost put Nvidia at one end of that particular graphic, and China on the completely opposite end of the spectrum. So I think it was worth taking a look at. The fact that Chinese stocks had fallen 60% for their sort of peak to trough, again, was not a bad entry point with hindsight, particularly given the 15 or 18% rise that we saw in Chinese stocks last week, which is just about pushed them back into positive territory for the year to date. But I think it's a move in the right direction. And again, I think the Chinese are not going to just allow their economy to crumble moving forward. I think, bear in mind, actually, yes, they've not necessarily always made the right moves, and certainly quickly enough, but that does seem to be a bit of a sea change moving forward. I think there'll be more to come, but they're determined to get their growth up around 5% for this year and moving forward. And I think even if this doesn't work, we could expect to see further stimulus measures. We've already started to see it in terms of some of the tier one cities like Beijing and Shanghai reduce their restrictions in terms of additional property purchases to try to get the property sector moving again. And so much of the economy does rely on keeping the property sector buoyant. So I think it's worth having some exposure to within portfolios. Bear in mind it's still a higher risk area of investment. You're still a bit beholden to the whims of the Chinese government. You don't want to be at the wrong end of some of their decisions, but also just try to understand the mindset behind Chinese authorities. What do they want moving forward? Well, ultimately they're going to want to be at the forefront of the the technology revolution. They're going to want not to be left behind in terms of AI and EVs, etc. So we are moving into a world where increasingly there are going to be two blocks. There's going to be kind of the US Western world block, and there's going to be China and its allies, block. And actually, maybe having exposure to technology in both areas is, going to have to be part and parcel of your portfolio strategy, moving forward. But China, I like more because no one else, seems to like it at this moment. Spain, again, I haven't really got any strong feelings in terms of the Spanish economy, moving forward. I think we tend to look at it more from a European perspective. I think I'm looking at saying, well, actually, Europe again is relatively cheap, is relatively unloved. So I'd put it more in the category of the kind of the UK at this moment in time, where I think again you're buying it at a relatively cheap valuation levels at this moment in time. And I think if you look on a 5 to 10 year view, those sort of entry points have historically not been too bad in terms of making money moving forward. So have a look at it. Certainly don't have nothing in the UK or Europe would be my argument.
Fantastic. Well, thank you so much. Just to remind everyone as well, the slide deck will be emailed to all of you, and there's also a recording that will be sent. So there was quite some quite good slides with some really interesting stats that I'm sure some of you would want to remind yourself of again. So you will all get a copy of that. And we have our next webinar, which will be the 22nd of October. So details will follow at the end of the week in our Pulse newsletter if you want to register for that. And as I very badly tried to word at the beginning, we have CPD certificates available. And if anyone would like a CPD certificate, if you'd like to contact myself or Steve Newell, we will be able to arrange for one of them to be sent out to you. But it just remains for me to thank Justin. Thank you so much for your time, for your really interesting slides. Thanks everyone for joining, and we look forward to welcoming everyone to our next webinar on the 22nd. Thanks again, everyone. Thank you.
Thank you, Linda. Thank you. Goodbye.